Welcome to Tim Talks Private Equity and Venture, where Tim Cunningham sits down with leading GPs and private markets professionals to explore the dynamic world of private capital. Since 2002, Tim and his team at Touchstone Group have been at the forefront of raising capital for buyout, growth, and venture funds. With decades of hands-on experience working alongside private equity and venture LPs and GPs, Tim brings deep industry insight and expertise to every conversation. Join us for candid discussions with GPs who are shaping private capital today. Now here's Tim.
Hey everybody, it's Tim Cunningham here for another Tim Talks Private Equity and Venture. My guest today, Scott Heberlein, has spent the better part of 2 decades doing something most PE investors talk about but really execute. They rarely execute. He and his team at HealthEdge find founder-built healthcare businesses that the market is undervalued, and typically they've got something that HealthEdge can do to put things right. Part of that is putting the right operators in the room and ultimately building these businesses into something worth multiples of what they paid. Scott is a partner at HealthEdge Investment Partners. They're located in Tampa, Florida, and they've been quietly compounding capital in the lower middle market healthcare space since 2005. In that time, the firm's completed well over 80 transactions across 4 funds and returned $400 million to its limited partners, generating a 3.4 gross MOIC on realized investments. So this puts them in rare company. HealthEdge really doesn't chase the kind of headline companies. They don't do mega cap roll-ups or platform auctions or whatever. They buy founder-run businesses with 3 to 15 million in EBITDA and healthcare services. And they've got several sleeves. We'll talk to Scott a little bit about some specialty products, pharma supply chain, and tech-enabled outsourcing. And often they have to put in new management, new systems, add-ons, and eventually a sale. Scott joined the firm like 11 years ago, and he's a partner and an IC member. And he's been really instrumental in deploying and managing capital across Funds 3, 4, and soon Fund 5. We're not here to pitch you on HealthEdge. We really want to work on the strategy and understanding really what works in lower market healthcare and what doesn't. Hey, Scott, welcome to the show.
Tim, how are you? That was a good introduction. I was looking at my own sheet here. I think you nailed every statistic, hit the nail on the head. It's almost as if you have marketed our fund before.
Full disclosure, we've been partnered with these guys in various fundraising assignments for a number of years, and think really highly of them. And importantly, Scott and his partners are the kind of folks who are not only transparent, but have really high integrity. And in a business that's based on trust, that's just invaluable. So we appreciate our relationship with them. So Scott, HealthEdge has stayed exclusively in the lower middle market healthcare for over 20 years and not drifting up market or into adjacent strategies. Mandate creep, strategy creep is all too common here. What keeps you guys disciplined in this space?
Yeah, and I mean, you've known me for a number of years now, Tim. So you knew I used to be an LP for, a little while, jumping over to that side. And I think just like you said, I saw a number of managers, and look, it's attractive, right? I mean, managing 200 million in a capital pool versus 800 million, there's certain things you pick up with that type of scale. And frankly, you can generate a lot for yourself with less return to the LP, which isn't as good to the LP. For us, I think the mandate and the mission has always been, let's structure our firm and execute on a strategy that allows us to come alongside the entrepreneur founder in these small cap or lower middle market, as you call it, healthcare companies, and really help them, through a lot of those swim lanes that you mentioned in terms of, talent acquisition and upgrading and infrastructure, et cetera, turn what is, a great product or service, which we are seeking to underwrite, into a great company. And, when you do that, with a small cap business, that is typically, 10, 15 in EBITDA and below, I think your opportunity set to then, try and underwrite a 3 to 5 times type of cash on cash return on a per deal basis is just higher than if you're already starting with that true mid-market size business, say 25 to maybe $75 million in EBITDA. It's just simply more difficult to really make that
harder to move the needle.
Yeah, a 3 to 5 times deal.
When you joined Brian and Phil in 2014, what did you see? What did you see at HealthEdge that convinced you it was the right platform to bet your career on? And what kind of surprised you once you were inside working the deals?
Well, being in Florida was cool. I was living up in, as you know, Cincinnati, Ohio, at the time. And, I think it was kind of winterish time up there. Not that Cincinnati is like my old hometown of Milwaukee, where you get feet and feet of snow, every month, but it was still chilly. So it was cool coming down to Florida, of course, but, no, and I had been here before, as you know, for about a decade, with a separate generalist firm. I'd actually known Phil and Brian a little bit. Tampa has grown significantly, both just as a town of population, particularly post-COVID, but we've also got a good bit more here now in the financial services realm and the investor community than we did going back 15, 20 years ago. But put my LP hat on a little bit, when I was out looking for a new gig, coming out of my LP role, put some folks through the paces, I guess. And what was real interesting, I think, about what Brian and Phil and then Jeff Thompson becoming part of the GP and a member of the IC as well, what they put together was something that, I really didn't see with say $500 million AUM managers. And that was a core GP and an investment team that wasn't just constructed of, very typical kind of iBanker folks background. But we had a number of people, everywhere from full-on partners of the firm to mid-level and junior-level folks that had an operating background. And so it was really, again, going back to that core design of constructing the firm and then the staff at the firm to be able to be effective and coming alongside of that entrepreneur founder and really help them drive their business forward. So I saw that, again, with the bigger managers, but it was unique, I think, to have that, really down on this small end of the marketplace.
Yeah, boots on the ground. Sounds an old phrase, but you can get closer to these companies. They're smaller and more manageable, and the levers you can pull end up being more direct. You don't have to work through as many layers of stuff. So as a placement agent, we often say, don't use the word proprietary, right? For your deal flow. It's just like everybody's claiming proprietary deal flow. But you guys actually do have some elements of this. What does that pipeline engine look like in practice? And what sort of things can't competitors replicate in terms of getting access to the kinds of deals you guys have?
Yeah, it's funny you mentioned that word, and I know you and your partner Greg and I have joked about this in the past, but I mean, I almost took the approach when I was sitting in a GP pitch way back in the day. If a GP would just come on through and A, not mention the word proprietary, and B, go so far as to tell me all we do are auction deals, I got to tell you, man, my ears would perk up and I would probably pay more attention in that meeting.
Just the honesty of it.
Yeah. Just the pure candor.
Somebody's doing these auctions. The bankers are making some money out there. They're making some coin.
You got to wonder, man. I mean, if every GP is only doing proprietary deals, how in the world are the iBankers getting paid? Because it sure seems like no one's using them. But no. All joking aside, look, I've been in this role with my brief stint on the LP side, but I've been in this world for 26 years now. It has gotten harder over that time to find, the classic definition of the proprietary deal where there really isn't anybody in the ear of the owner or the owners guiding them on valuation or guiding them on market terms or whatever that may be. Because look, the ultimate mission and the nirvana, right, of trying to, be able to truthfully say, half our deals we do are proprietary. The inference on that is, of course, well, that's great because it must mean you guys are paying less than what a full market multiple would dictate. And so that's great if I'm an institutional LP, because I can, walk in thinking that half of your fund at a minimum, you're going to have baked in arbitrage out of the gate. And that's, of course, a great thing. And, it's one of the three, keys, of creating equity value. But it has gotten harder over time. I think that, certainly a proliferation of folks out there, business brokers to attorneys, accountants, everybody that can represent and advise.
Yeah. And the independent sponsors now, I understand you guys have done some business with independent sponsors, and that's a whole new thing.
It is. It's a fascinating space. I know, a number of institutional LPs like to do a deal or two, so as to vet that independent sponsor. Maybe when they do raise a fund, then it's a way to commit capital. It's honestly makes it a little bit harder though for our job as a funded GP. The vast majority, I think, of the independent sponsor groups out there, it's not their capital, to start out from day one. It is the capital of the equity provider.
Well, almost by definition, really. They used to be called fundless sponsors. Remember that? Fundless sponsors.
That's the dirty. You don't use the F word though. It's independent. But no, I mean, look, back to the original question. It is more rare today, candidly, to find the true proprietary deal. I think that, going back to, some of the original intro, part of the reason that we are still able to successfully uncover those opportunities is, a 21-year consistent focus now in this small cap U.S. healthcare market.
You get to be known.
Yep. So good brand name and we don't have individual kind of silo mandates in terms of functionality here at the firm. We all are responsible for sourcing opportunities. We all have Rolodexes that there's a degree of overlap, but, we have our own folks in there as well. And so we have operating partners that have referred to us, proprietary looks at deals. We have uncovered proprietary deals. But look, if you're an institutional LP listening, if anybody, is telling you that, every deal we've done in the last 10 years is proprietary, man, I would diligence the phooey out of that.
Run for the hills. Yeah.
Yeah.
So, okay. You guys deliberately avoid, broadly speaking, reimbursement and regulatory risks. You try and steer around deals that have those embedded in them. But healthcare is almost entirely shaped by reimbursement and regulatory stuff. So where do you guys draw the line? And has it ever cost you a deal you regretted passing on?
Oh man, that's a good part two of that question. I'm going to think of that as I answer part one here. Our general tolerance, I'll hit the reimbursement dynamic first. And, man, oh man, under the current administration, the Medicare word has not carried a ton of weight in terms of uncertainty. But good grief, you put Kate on the end of that instead of care. And, man, good Lord, you just throw a whole bunch of question marks out there. So now, ironic as it is, and as much chatter as there's been, we've got, one business now in particular, kind of in the Appalachian Mountain region providing oral surgery services. And we really haven't seen any change in the Kate patients that roll through the chairs there. So despite all the rhetoric, I think the actual impact has been pretty mild. But from a portfolio exposure level, which I think gets to the crux of the LP question, we are generally not seeking to expose more than 15 to 20% of the fund's invested capital to deals where there is, very classic definition of reimbursement risk.
Yeah, but you've done some compliance related stuff, trying to hay.
Play on the trend. Right.
Yeah.
That's a great point. So, recognizing the complexity, of reimbursement and just the heightened need to be in compliance given regulatory scrutiny, which really has never gone down or eased up and probably never will, nor should it within healthcare. We have made some good returns on businesses that just, by way of example, I know you know this one, but we had a great Fund 2 investment that started out with really a single swim lane of service, providing compliance consulting services for folks that operated a post-acute care facility. And then we very successfully expanded that through add-on acquisition into doing revenue cycle management services for the same customer base, medical coding for the same customer base. We also had some education.
And for those for the casual healthcare related listeners, revenue cycle management. It means receivables and how you manage your receivables.
Yep, collecting the cash. Exactly.
Yeah, and it's made more complicated by the many layers of insurance we have, public and private, and the requirements of each to do this and that. So it's a complicated business, and to reduce the friction and increase the receipts, it has attained its own sector or subsector. Yeah. I suppose that could go away if we were to get a single payer system of some sort, right?
Yeah. That's not going to happen. But
no, I don't think so either.
AI has clearly affected it, though. I think that when in the back, I'd say quarter to third of our hold time with that business, we were in the early stages of seeing how things like AI, early stage AI, which really wasn't full on AI, but, helped automate some of our process, could take what we as a provider of that outsourced tech-enabled service, if we could do it, a little bit quicker, with a little bit less, human resource too. And we successfully did that. Our CEO was a fantastic individual, very plugged into the tech dynamic of things in addition to the healthcare side. So he did an amazing job, taking a line of business for us on coding that, began as about a 26% gross margin business. Mm-hmm. And it was darn near 60% when we exited. Now, some of that was economies of scale, but a lot of it was bringing technology to bear to automate a lot of what was, formerly solely done.
Yeah, and I think we've got at least two prongs of this AI issue in healthcare. One, of course, is in diagnosis and therapy. Mm-hmm. And that, I think, is going to revolutionize a lot of stuff where these models are doing as good a job or better job in some cases than many other professionals. And then there's the whole friction of the system and people making having businesses that need to reduce the friction that all levels of the healthcare sector have, and consumer friction, payer friction, doctor friction, healthcare complex friction. And as we see these agentic AI come forward, a number of the SaaS kinds of companies are going to get gutted pretty quickly. I think the public markets are showing that. Maybe not as quickly as like an immediate sell-off, but we can talk about that in a bit. I'd like to talk a little bit about how conversations with founders, owners, about who's staying involved and how often it might go sideways. 75% of the platforms, you're replacing a CEO and a new CFO and virtually all of them. That's a pretty blunt number. What does that speak to the way you guys want to manage the deal? And when do you have those conversations? It's really important to know. And the third thing is, and I think you guys would admit this, the biggest mistake you can make with the C-level guys is not getting rid of somebody quick enough, that they can hurt the value of the asset pretty darn quickly, and you guys have to be decisive. So that it's a whole playbook here you guys have, but how does that conversation go?
Yeah, I love your tagline at the end there. I mean, never in the history of private equity led boards of directors has anybody ever stepped back and said, "Man, oh man, we really should have kept that individual longer in the seat." Right?
That's right.
It is always the opposite. And same thing probably goes for divorce and personal lives. But if to go all the way back to your root here, and as I think back in the career, I started as a generalist, and in that role, I don't recall that firm back then. I don't know that we ever changed a CEO unless at the time of doing the deal, it was an individual that was simply aging out, wanted to retire, and just wanted to go hang on the beach for a while. But it was super, super rare. But what we did run into in the generalist world of very traditional kind of nuts and bolts manufacturing, business service companies was a lot of individuals that came from that business managerial building background. And so there's a degree of them that were situated to continue building that enterprise from the 20, 30, $40 million that it began at to the 75 or 100 that we tried to drive it to ultimately exit. Healthcare is different, man. You see businesses founded by doctors, by dentists, by folks that came out of, an academia type of role, by scientists, all of which candidly are probably smarter than the average business backgrounded undergrad or grad. But what it typically does mean as well is they have put all of their time and all their resources into developing whatever the product or the services that their company is providing out in the marketplace. Oftentimes they put too much time into that and they come into the office trying to get 30 things done every day just because that's how they're wired. And so,
right. Or they have 35 salespeople reporting
to them, along with the whole finance staff, along with the whole sourcing staff and the IT staff. And they got 300 people.
Or 50 different projects that they really want to get done.
Yeah.
And products that are so exciting and new things that they have to do. And so there's a bunch of that going on too, right?
100%. So the vast majority, to get to the root of your question, the vast majority of the instances where we are bringing in someone new in that, full on CEO seat, it's a conversation that starts very early. I'm not going to say it starts before indication of interest, but, it'll happen, round about the formal LOI stage. It is absolutely occurring, as we're negotiating definitive agreements because we're trying to lay the track for, what does this business need to look like? What do we need to accomplish in the first 180 days? And part of that is probably, going to search for the individual that, will take your seat, Mr. or Mrs. Owner, as you transition to a different type of role. Rarely are they moving out of the business in the entirety. It is their company. We will never know as much about that world, that industry, that niche, as they do since they started. So we want to keep that talent and that knowledge base involved. Maybe it means they move to a chief strategy officer role. Maybe it means they move to a board type role, or just something different that isn't the day-to-day minutia of running the company as a CEO. So it is rarely contentious. The only times where I suppose it goes there is, not every instance, believe it or not, after 21 years, have we made the right call the first time. We've actually made a mistake or two or three, that we've hopefully learned good things from over time. So, it's those instances where we think, hey, maybe, we may have the right individual here. Let's give it a go, for the first X number of, months or quarters. And sometimes it doesn't work out. But, to your point, I think the thing that after over 2 decades now of doing this, that we have become a lot better at is let's not admire that problem for too long. Let's pick a decision and go with it
and move on. Yeah. So let's talk about multiple expansion a little bit from entry to exit. You guys typically have an uplift from, I don't know, you're buying at 7.5, something like that, and selling at, 13, 14. So how much of that re-rating is from kind of market conditions? That is to say, bigger company, more targets for exit, perhaps they're strategics as well as financials, et cetera, versus genuine operational transformation. That is the stuff, the value add that you guys can put your hands on and say, you know what? We did make this company better, but we also really transformed it. And how do you make that case to a skeptical LP?
Yeah, no, look, there's some degree, I'm going to say it's a small minority of degree that is just simply getting the thing bigger. I mean, in your world, operating in what junior partners do, you guys are more well aware than we probably are of what the capital overhang looks like in terms of the true middle market buyers out there and the need for them to actually get that money to work. And so, there has been and continues to be, I think, a shortage of assets that, pass snuff for those folks in terms of a very clean, ready to go business that on the day that mid-market fund buys it, it's actually ready to grow and they don't have to spend the first 18 to 24 months building infrastructure and putting people in.
What always fascinated me about your strategy was, and I heard you and everybody, in fact, Brian, Phil, everybody talk about this. You want to leave enough on the table, clear running room for your purchaser, for your buyer, to actually see how they can win as well. And, maximizing every little jot and tittle means it's not going to have the kind of exit and success on exit that you can as if you instead kind of paint a real picture that, hey guys, there's some runway here. We've teed this up for you. Go ahead and whack that ball. I just thought that I haven't heard other folks talk about it that way. And it's not only a decent thing to do, it seems like smart business.
Yeah. And it's funny. I mean, I guess you got to be careful how you say that and make sure the audience, if you're sitting at the LP table, understands what we're not trying to do is undershoot the value we want to deliver to our fund and then hence the LPs by selling something short. But in order to maximize, the level of interest, which drives a high competitive process, which drives the ultimate multiple on EBITDA that people are going to pay for your business, you can't pass someone something where all that juice has been squeezed out of the fruit, right? You've got to show different swim lanes, organic, M&A, whatever else that next buyer can easily buy their way into and see, hey, I have a path to underwrite an X return on this deal as well.
Yeah, just show them some way that they can really win.
Yeah. Plus, we want a reputation in the marketplace of selling good businesses, right? I mean, we've been at this long enough that, as we go to market on our own, to exit certain things, there's certain buyers out there that, haven't run into them before, maybe not had the most amazing experience. We just don't put them on the list. But we want to be a seller out there as a small cap focused fund that, the middle market funds really enjoy looking at our deals because they know we built a quality asset.
Exactly. Yeah. More willing buyers out there. So, there's some pretty big spread among the MOICs that you guys have demonstrated, right? I mean, we had Formulated Solutions at like a 10x gross, and Curta was like 8.5, 9x, something like that. And Omega was almost 7. Do those three companies have something in common that your other deals that are, that have not been as successful didn't have? It's more about the circumstances of the individual transaction and the company and so forth, or timing, than some kind of commonality.
Yeah, that's a good question. I couldn't tell you that there's a common thread or two, that if you stacked them all up against every other deal, it's not the case that, we had massive multiple arbitrage in those three versus not the others, or that we had a different debt structure in those versus the others, or management team or anything. I think largely circumstantial, to each deal. None of those three was in a remotely similar sector. Either Omega was doing offshore medical coding type of work. Corridor was doing onshore rev cycle management and coding, but for a different type of customer base. Though the two of them worked together at one point, which was interesting. And then Formulated was doing blending and packaging and formulation development for all sorts of consumer and RX products. A real different space there. So no, it has been more circumstantial. It's great to get those deals. We're not a venture fund though. We're not trying to be a venture fund. So we're not trying to, shoot for 2 10x deals in a fund to make up for ones that don't go so well. The general underwriting has always remained, hey, we want to drive 3 to 5 per deal. Now, as we get into a fund and, lo and behold, not every deal always goes exactly how the LBO model says before you close.
No kidding.
But there's also something to be said, a la a Corridor, certainly, and an Omega and a Formulated. You run with your winners, right? And if you see a path to an extra 12 to 18 months of hold equals going from a 3.5 MOIC to a 6 or a 7 or better, you hold and you keep running with that. You allocate your time and your resources as such as well.
You mentioned that not every deal goes according to the model. So there was a misstep, I guess you could call it, with the Legacy Expire deal. And what did you learn from that? And has it changed anything about how you might underwrite pharma supply chain sort of stuff? Is it specific to that sector, or was there something else going on?
Yeah, I mean, I tell you, the learning was let's not have a global pandemic. It's probably just by way of background, so we've got some good deep experience, and we've actually made a lot of money on some deals where we're buying a product. So these folks did some RX products for some very good indications that made a ton of sense. We thought we had the right, kind of stable of operators that we could surround the founders of this business with to help, create more scale and broader distribution and obviously, drive revenue and EBITDA. The bulk of all of the sales were generated at Legacy, like a very traditional, pharmaceutical product would be, in that you need to have a rep in a doctor's office talking about why to use this particular RX for this particular indication. A lot of it was also on the pain med side of things, non-opioid. So we were trying to, play the right side of that from a non-opioid treatment standpoint. But, darned if we didn't do that deal, in kind of mid to early December, the year right before the pandemic happened, call 3 months later. On top of that, a lot of the scripting for that med was due to folks going in for a surgery of some sort. Now you got elective and non-elective obviously kept on going. But when you take elective surgeries out of the equation, anywhere between, Lord knows how long California was shut down for that. Florida was obviously only 1 week because we had COVID for a week down here. But, it really put a challenge to that business in the first, call it 4 or 5 months, where we had, challenges getting anybody in a doctor office to push the med. And then on top of that, again, surgeries, dropping precipitously. So, unfortunately, for a lot of us in our world, we all get to a point where you sit at your IC and you're facing the question of, well, do we put more money in here, or do we allocate it elsewhere?
Right. The old checkbook discipline problem.
Yeah, I think we made the right call here on not chasing this one, unknowing when things would come back. And so, unfortunately, like you said, not the best deal, obviously, in the portfolio. But what we did end up doing, in turn, we had a business down here in Florida that we'd owned a little bit longer than Legacy, that had a growing post-acute care presence here within the state. We allocated some of the remaining dollars in that fund to doing acquisitions there, as well as providing some working capital. And, took that from a business that was sitting kind of, mid-single digits in EBITDA. That's now in the mid-teens in EBITDA, several years later. So, again, we don't always make the right call on every single thing we talk about in the conference room here, but, as painful as it was on the Legacy deal, I think this one was very.
Were there other deals that were similarly affected by the pandemic?
We had one that, it was in that fund as well, where, call it 85 to 90% of their customer base, was shut down, completely. It was a specialty type of medical office that, kind of a third tier type thing. It wasn't primary care or dentistry or anything like that, kind of a third tier type provider, but, that customer base was complete. And so, we took the time we grew gross margins a little bit by improving the operations, but it was a tough roll getting through that one as well. So the lesson learned, don't go through a pandemic, but if you do, which I think we did do this part quite well. We, immediately as all that started happening, going back a number of years now, we were meeting with our entire C-suite team multiple times a week, just doing things as simple as cash planning and drawing down on revolvers when available to make sure we had the resources and liquidity that was available to make it to the other side for the businesses that were more affected.
Yeah. In general, you're still projecting some pretty good outcomes on unrealized assets, but I think LPs are going to mark that gap, right? So how do you contextualize that performance without sounding defensive? Because I don't think you guys have anything to be defensive about, but it does take an explanation for how stuff happened.
Yeah, and better than anybody as well. Part of that is, when are you taking yourself to market? And how much can you show as actual movement in the performance of the business versus we think it will improve. And
promise.
Yeah, I think particularly in the back half of last year for a couple that were lagging a little bit, up until then, we've seen the actual improvement in performance. Now there's still room to go in both, I think, to get to the ultimate MOIC that we like to drive them to, for an ultimate exit. But, again, having been an LP myself for a few years, I'd say we're highly cognizant around here of making sure we're timing the right conversations with potential investors with a time frame when what we tell them verbally is actually diligenceable, when we dive deep into the details.
So what's the internal policy for communicating with LPs when there's good news, or conversely when there's bad news? I mean, do you guys want to hold back a little bit and wait for things to unroll a little, and or do you want to kind of get in front of it and say, look, still pieces of this problem rolling around, but here's what's going on? How do you guys approach that?
Yeah, I mean, I'd tell you we're upfront and ahead of the game on both, if not more upfront on the bad stuff, and maybe holding back just a tiny bit to hedge a little bit on the good stuff. But as which I know our listeners don't, so our capital base today, we're made up of about half of the dollars in the last couple of funds are high net worth family office dollars from, frankly, a lot of individuals and families in and around the Florida and Tampa Bay area that all of us know, and maybe we see it there from time to time when we're out on a Friday night. The other half are made up of very typical institutional dollars, corporate pensions, fund of funds, university endowments, etc. So, we're held by that first dynamic to a heck of a standard. And that, running into folks on a random basis, not that we wouldn't do this anyway for the institutions, but you want to be communicative, when anything isn't going the right direction. But, I think do it the right way. And if we've got a solution in place, we're ensuring that we're laying that fact pattern out there for folks as well. So, we actually it's funny, we just had a good, robust discussion with one of our institutional fund of fund LPs out in New York in the last 30 days or so about valuation policy. And I think there's a pretty big spread, and I know you've seen it, as far as what do folks do in terms of when they mark stuff up, when they mark stuff down. God forbid they ever mark, stuff down. Some folks never do until all of a sudden it goes from 2 times to 0, and you're like, well, what the hell happened? But, so we worked with them, actually. They've got very, very broad perspective in terms of what, better part of, I'd say, 80 to 100 small cap GPs are generally doing with things. So I think we're refining that a little bit, just to, provide more transparency and just more accuracy. One thing that we've been, I think, really, really good at is, I don't think we've ever had an exit, Tim, where it wasn't for a meaningful amount of a higher MOIC than what was shown in the most recent quarterly report for that deal. Now, that's nice to be able to provide the surprise to the LPs. Hey, you had it marked at 3 and you made 4.5 times. That's great. But it's also not helping us necessarily along the way in terms of providing, perhaps what the true market mark is for everything. So.
Well, but I think you've characterized it right. The way, bad news, you want to get that out first, because human nature being what it is, nobody likes to report bad news. So you separate yourself from a number of other GPs just by getting out front. And we had a recent situation with a current client where we urged them to get out front. And it's just one deal, but still, it's a deal that ended up, a subject of a column in the New York Times. And you want to be out to your LPs in front of your LPs saying, okay, here's what's going on, fluid situation, but we want to give you a heads up before you read it in the paper.
Yeah. Yeah.
So it really is. And being a little less confident to mark up because, shit happens, right? And you got to be careful. Okay. So post-acute care, behavioral health, dental, revenue cycle management, specialty devices, all areas, subsectors where you've operated. Which subsectors right now do you think are the most mispriced, whether they're overpriced or underpriced or whatever, and how come in the subsectors you guys focus on?
I just saw a substance abuse deal within the last 2 days or so here that someone passed over to my desk. And I mean, that is a sector that seems like it's been overpriced for quite some time now. The efficacy of these things has not been super fantastic. The rescission rate is pretty high. There's a whole dynamic sitting out there with folks that operate these centers getting paid for doing kind of daily, weekly urine testing, which they get a ton of money for. It really hasn't the clamp hasn't come down on that reimbursement just yet. So we've never taken an interest in it, for a variety of those reasons. But it's funny. I just saw one of those things, out there the other day.
This is the GLPs you're talking about.
No, substance abuse.
Oh, substance abuse. I'm sorry, I misunderstood. Oh, okay. Okay.
Yep. Dental's ratcheted back a little bit. So we've got a DSO in the portfolio, and rightfully so. Going back a year and a half or so ago, we run a good spree of M&A, and then something happened, and whether it was news announcements, some of the big DSOs doing deals, but all these dentists that we were talking to in terms of joining our practice, all of a sudden, 10 to 14 times is what they wanted for their practice that was doing 700 grand in EBITDA. Like, well, that's just not going to happen. I mean, if you're 50 million in EBITDA and you're a full blown DSO, okay, I get it, but that's not how the world. But a lot of folks chase those up, and I think a lot of DSOs got themselves upside down on leverage. And interest is more expensive now than it was 2-3 years ago. And so you see a lot of folks in that world, I think, have troubles. We took time off because we remained disciplined on the purchase multiple and said, well, we're just not going to pay that. It's not right. And that's come back down. I'm answering your question reverse here, but that's come back down compared to what it was, I think, a year, 2 years ago, back to where it should be, frankly. So.
Yeah, I was at a conference last week, the Nexus PEI event. And
you came down to our state. You enjoyed some sun.
I did, to Orlando. Yeah. And I understand Phil and Brian are going to be at the Super Return North America. I'm going to be moderating a panel there. And by the way, if you guys want to get on panels within Pharma, I've developed a pretty good relationship with them. So just kind of an FYI. But it was really interesting. I spoke with an RIA and who will go nameless. And I asked him about all the roll-ups because we met with an RIA that's grown in 2.5 years from $2 billion in assets under advisement to $42 billion. So they've had a lot of these practices. And this RIA said, yeah, we're just waiting. In the next 6 months, we're getting an offer. And it seemed to me, I was thinking of the dentists when I heard that, that people are sitting around saying, "Oh man, we're getting an offer," because the roll-ups are just moving so quickly apace, right?
Yeah, they forget how important organic growth is too. I mean, the number of times that we've had the discussion with all our dentist partners in our deal that, I mean, it's growing via M&A is cool, and everybody likes closing deals, but the dollar you buy is not as valuable as the dollar that you generate internally. And I mean, we may have had that conversation 15 times in the last several years. Then at some point it'll sink in. But I get it though. I mean, I'm not in their world, so I could sit and try and read a chart and learn about fixing this tooth and that tooth, and it's all going to be Greek to me. So I get why it's tough to wrap the arms around. But you got so many folks out there, the MB2s and the bigger DSO groups that they blast out weekly how many deals they closed last week, and it just creates a buzz that isn't perhaps as deserved in terms of actually growing equity value as it could be.
Yeah, I mean, people get unrealistic expectations based on buzz, and ultimately, the capital has to find returns that are attractive, and when multiples get out of range, that's hard. So I would imagine you've seen purchase multiples sort of creep up over the years. How does that look now, kind of in general, for the spaces you guys invest in? Are the multiples flattening out? Are they still increasing? Are they decreasing? What's going on?
Yeah, I think we've been about flat for the better part of, I'd tell you, as far as where we're buying things. And again, that's generally, call it 3-ish in EBITDA to maybe 12-ish has been the zone of the deals we've looked at.
Is that your underwriting or the market? Are you just being more selective, or do you feel like the market's kind of been stable?
Well, yeah, it's funny though. We've had a bunch of deals, man, that, take a $5 million EBITDA deal just to make the arithmetic easy here. If it's a 7-8 times deal and we start running down the pike, I think quality of financial diligence has been an area that we've struggled with on some add-ons and some platforms. Yeah, I've talked to some other folks and I've heard the same type of feedback, but you think you're bidding off of 5, and 5 is actually 3.2. And
right.
At least from what we've seen on a number of these, and a lot of them are represented by maybe a broker, just someone who's a halfway smart to fully smart advisor. is there's Zippo desire from the selling shareholder group then to listen to what an appropriate readjustment to that price may be, based on what the real EBITDA is.
Is this kind of post the quality of earnings assessment?
Yeah. So, for whatever reason, quality is just, it's not what it was a couple of years back. But I don't think multiples have for where we're buying things, I don't think multiples have gone up. I think they've been pretty consistent.
Yeah, but the QOE becomes really important in that environment. You really got to see, okay, let's look at free cash flow. Let's look at how this moves through the snake, figure out what the heck's really going on here. Particularly with respect to receivables and almost any kind of a healthcare-related endeavor. They can be opaque and difficult, and who knows whether they're applying the right metrics to valuing them. It's always a big challenge. Hence the subsector revenue cycle management.
Yeah. Well, I mean, it's the funniest thing in some of these practice. I mean, every practice business we've ever looked at is always on a cash basis type of thing. And then you get the doctor, the dentist, or whatever the practitioner is that's running it, and they're not thinking accrual because they've probably never heard the word. And so they're getting the business ready for exit. And so they got their office staff, in the final month that they're looking to lump into their 12 months here. They're calling everybody that has an outstanding AR and they're collecting all of it. And so they're taking 3 months worth of AR and they're stuffing it all into 1 month. And so they're giving me 14 months, worth of accrual. And here it is in 12 months of cash bid off of this. And like, well, that's not how it works. But
yeah, I owned a healthcare company many years ago, and the guy who was running it pledged our receivables to 2 banks. And one of the banks neglected to file their UCC1, and I had to get it refinanced. It occasioned some embarrassing conversations when the bank officer came into my office and told me that was a federal felony.
Yeah.
I'm going, oh, man, really?
Yeah.
But we managed to refinance it, and everybody got whole. But my goodness gracious. So let's turn to AI for a bit, because I think we've got this tsunami coming down on our beach, and we really don't know how tall it's going to be or how far up the shore it's going to wash. But it seems like it's reshaping kind of every business out there. I don't know if you're using on a daily basis. I certainly am. And so, coding, RCM, care coordination, tech-enabled outsourcing, all of those areas. Is it a tailwind that ultimately accelerates exits in any way, or is it just a threat to recurring revenue profiles you underwrote? I mean, how do you guys see the market for this and the developments?
Well, this isn't even me that you're actually talking to today. This is my AI version. I'm on a management meeting, aboard this.
Scott the agent.
Yeah, so that's how we're using AI at HealthEdge. No, it's a few questions embedded in there. It's funny. We just had a session earlier with the team where we were talking about some additional ways that maybe we should be incorporating this in just some of our own daily kind of quarterly LP interaction processes around here. So we started using it, I guess, more broadly across the firm for HealthEdge internal purposes, probably going back a year, maybe a year and a quarter. We've all got, so you've got the plugin now, the Claude plugin thing that you can do with the Microsoft products. You got the paid kind of enterprise version of chat that keeps everything confidential and has a little more horsepower to it. So I think there's some things that we've used it for to, I think, get things done maybe a little bit quicker and highly accurately internally here. Identifying trends across deals. Now that we've got 21 years of history of being able to load deals, into the system as well, of what are generally things that have worked well for us, what maybe has not worked as well, what are some things that we do post-close that actually move that value creation needle versus don't. So I think we're still early on in it. We've got, room to go to keep getting better at using it internally here. As far as our portfolio, businesses, I think it has largely been something where, we need to be incorporating it into the general daily, weekly operations to do what is being done in a more efficient basis. And if that means we're saving costs because we're cutting some resources out of the business that we just simply don't need anymore, we can do it more accurately, with the AI to get done on the first pass versus a third pass. Or, taking this back to the dental example, because we keep talking dental here, we started using AI within our TDN dental business, specifically the practices that are taking x-rays, the better part of a year and a half ago, to do the first pass evaluation of all the bite wing kind of mouth wide x-rays. And it's identifying things that, not that our doctors aren't competent of doing this, but AI is really good at doing it. So we're finding more things earlier on so that we can intervene with maybe a lesser type of treatment for the patient.
Yeah, it feels like radiology is going to be an early beneficiary of all of this because of pattern recognition going on with this stuff.
Yep. But, processing, paperwork and claims and billing data. We've got a business up in my old hometown in Milwaukee that's a diabetic footwear designer, manufacturer, supplier. And one of the Achilles heels, no pun intended, in this world is...
Yeah, so repeat that. You said it quickly. Diabetic shoe manufacturer.
Yeah.
This is cool. I know this deal, but it's these are custom made, right?
Fully custom to each foot. It's an RX product. You get it through a podiatrist, or what the industry calls a podorthist. But, one thing that is challenging for the prescriber to get reimbursed from CMS or insurance, whereas they got to gather a bunch of paperwork. And a lot of the paperwork they have to gather isn't from them doing it. They actually have to get it from the patient's GP doctor. And it's been a bit of a barrier to folks wanting to get into this business of dispensing and selling shoes. And so we've got an AI pilot, actually, that the company is trialing right now with one of its bigger national accounts, where using AI, we're truncating that whole process of gathering the documentation. And as we gather it, we're doing it in a more accurate manner because we're reading doctor notes. We're taking the verbal doctor notes, putting it into textual type format.
Interesting.
And I think fast tracking a barrier that has been something in that industry for a little while. So if we can get that working, I think we're easily first mover in doing that. So all of that to say, as I think about the totality of the portfolio across our Fund 3 and Fund 4 today, does AI pose a giant risk to eliminating the business model of what service they're providing or what product they're selling? No, I don't think so. But, if we don't ensure that our portfolio businesses are properly using AI in the areas that they should be to make them more efficient, if they do, we will be behind. And so there is an AI strategy.
Yeah, you'll get outcompeted by those who are using the tools.
Yep. And frankly, we need to have an AI section when we have an AGM, right? What are we doing in general at our firm to use AI to do what we do on a daily basis, which is ultimately locating great deals and growing those deals that'll make you, the LP, a good return. What are we doing with AI for that? And then hit it on the portfolio level as well.
Yeah, and not just the AGM. I think your deck needs to reflect this on a very specific basis. We've not seen that many folks out there who are laying it out. In other words, saying, okay, these are the portfolio companies and their opportunities and risks with respect to AI. Maybe you do a separate doc. I remember at one point we did an attribution analysis because of a partner that left and showing, who actually did what. That kind of analysis for AI would be very helpful, showing how each portfolio company you've been considering it and how is this going to work, and can we implement it inside this this company, and will people adopt it properly, and how many process steps can we eliminate, and those sorts of things. I think it's going to be important. Let's talk for a sec about co-investing. So many folks have institutional LPs have focused on co-investing, and originally it was just to lower their all-in expense ratio, right? So you don't charge as much for a co-invest, or you charge with some kind of interesting structure. You guys did one, I remember once, with optionality built into it, where depending on how things worked out, they could choose how you guys get paid, which I think is an interesting and creative way to look at it. What do you think the right co-invest to fund ratio might be? And are there specific kind of deal types you think are more appropriate than others for your LPs to invest? And if you have to go outside to do that, are there deal types that are going to be more attractive for co-investment?
it's funny. I was just looking at the stats for this, going back historically here before we hopped on the call. So we've had about 450 million of AUM across our funds that we've then invested, into those, 80 plus, as you said earlier, businesses that we've closed on. We've had 150-ish in total co-invest dollars that we've, raised alongside of that. Good chunk of that has been from LPs that, were in the fund. As you know, because you helped us with one of them. One of it was from an LP that wasn't in the fund that became an LP in the fund, which is always the nirvana situation for a GP like us. We want to get to know someone well, and they want to get to know us, and hopefully they come into the pooled vehicle. And then the rest of it's been outside folks, because perhaps our LP base just ran out of capacity for the individual deal. So, is it a specific type of deal? I'll go back actually to your reimbursement and regulatory risk comment. I think for folks that are an LP with us in the fund, they invested with us because they trust that we know what we are doing in regards to constructing the portfolio and picking the right investments, where we have the appropriate expertise to evaluate risk and opportunities within companies that may have a reimbursement or regulatory dynamic. So I think it has mattered less, frankly, for them when we show them a deal that either has that or doesn't. I would tell you that it matters more, though, going through one right now on a co-invest standpoint, when a deal does have a reimbursement or a regulatory dynamic, that it's an LP that is not exclusively a healthcare LP, which I don't know if there's like any of them out there. So we had a few turndowns, because of that dynamic on this one particular opportunity. But I get it. If you're not living and breathing this world every day like we are, or you're not an LP that has already underwrote us as your GP of choice to manage that risk and an opportunity set for you, it makes sense to me that you may want to pass on that. So yeah, it's been size dependent for us, right? I mean, we've got a dollar amount that's appropriate for the fund to take down. We allocate then to our LPs, of course, first, because that's what you should. And then outside of that, it's been folks that we've either interacted with through introductions from folks like yourself, or maybe that one of us has met along the trail some way that would make good sense. We like to go back to people that we've worked with before, folks that we trust and that we like, and vice versa. And then ultimately, and perhaps somewhat selfishly, to the extent we can, find parties that have an interest in co-investing to get to know us better. See how we operate, see how we grow business, see how we work through challenges with business. If that results in a commitment, then that's obvious.
So what do you think about the co-invest to fund ratio commitment? Because I remember a situation where we had a 35 all teed up for you guys, and somebody asked for a co-invest that was just a little overreach. They too will go unnamed.
Yeah, well, shoot. I mean that was a decent example, but I remember the other one where I think the primary commitment amount was somewhere around 5 to 10 million, but you had to show co-invest, and they expected to do at least one, and the minimum co-invest amount was 25 million.
Right.
You just leave that meeting thinking, that's amazing if you can do that, but
how the heck is that going to work? Yeah,
that is a tall order. So. Yeah, look, I mean, I think 1-to-1 is way out of bounds. I mean, you need to raise a bigger fund, and you should if that's where you're at. So, yeah, we've probably been, in a totality of a single pooled vehicle, maybe around 20%, somewhere around there. And it's not that it's the case on every single deal. There might be one large deal or two large deals out of a portfolio, and then some other smaller ones, but 20-25% range, feel appropriate. And I get it, especially for the fund of funds where you got that double fee layer, carry layer on things. I completely get it. So
got to lower that expense ratio. So, So talking a little bit about HealthEdge and the culture, and, you guys have had such a remarkably stable team for a long time. And, by a Fund 5, a lot of partnerships have seen a bunch of churn. What's the answer? Why has there been such a solid team? What's going on where you guys, continue to want to all work together, and you're senior people who could do other stuff too?
Yeah, it's just like the Tom Cruise movie, man. Nobody's ever left the firm, and you know what happens if they do. So no, it's look, like you said, look, we've got some folks that have done much bigger things. Jeff Thompson, before he joined the GP, or he ran a $1 billion+ company in 50 different countries, distribution wise around the globe. But he's here and he's working with us because it's just fun growing these small cap businesses and seeing the type of return generation I think that we've seen over time. So we all enjoy working with one another. We hang out from time to time, on an after work standpoint as well. We're all also bringing a slightly different skill set to the table. And so, we've got a batch of us at that partner level, but we're not necessarily all overlapping in what we've done historically and what value we're bringing to an individual deal. And I think that may be the biggest thing that's different as far as how you stack all of us up here versus maybe other types of funds where everybody came from spinning out of a typical, PE role or not investment banking role. And because we're all bringing something different, I think we recognize everybody's value. We want everybody to stay around here because everyone brings something to the deal. How to vet it, how to evaluate it, how to structure it, how to grow it, and how to properly exit it.
Mm-hmm. If you could go back and talk to Scott just starting out in his career, what kind of advice would you whisper in your own ear that you think ought to be kind of at the top of your list going forward from then and now? Bring some of this current wisdom back in time.
Yeah, man. Oh, going way back, I guess. Here. As I think back to the super early, so I got really lucky coming out of undergrad. I went to Virginia undergrad, and there was a firm that used to be here in Tampa called Florida Capital Partners that was started by two individuals that graduated from Virginia in 1985. And so, they had an opening for an analyst in the year 2000, which was kind of internet heyday, right? Back then when I was coming out of the undergrad business program there. So I ended up getting the job, which was great. And honestly, part of the reason I probably, got a little lucky here, they didn't post it until after almost everybody had a job. And I'd actually signed to go I was going to go do investment banking, which was kind of the traditional route. And, signed the offer letter, took the signing bonus, all that good stuff. And then I saw this, and this is back before we were using the internet, right? So I saw this on a piece of paper in the career service office of a private equity analyst. And that is back before nobody in undergrad knew what private equity was. But I said, this sounds interesting. So I asked a friend about it, and he knew a little bit more than I did. And so I applied for the thing and ended up interviewing, and they offered me probably 20% less than what I'd already signed a document for to go do investment banking. But I said, you know what? This sounds really interesting. I think I need to go do this. So I returned the signing bonus to the other folks, apologized profusely, and ended up down here. I would tell you, I was working a lot of 80, 100 hours a week back then, which is very much the norm. It's just what you do to cut your teeth kind of in this high finance world. I wish I would have spent a little more time back then, getting to understand some of the why on the deals. Not that I don't get it now, go fast forward the tape 26 years since I started doing all this, but it took me a number of years to lift my head out of the 100-foot level minutia of the modeling and the writing and the industry research to really start wrapping the brain around, well, let me understand the thesis that the partners at the IC are really thinking through here of underwriting this deal. And how are they going to drive this thing to ultimately make a return at the end of the day, and then start to recognize the patterns in doing that? I was crunching LBO models, at 11 p.m. or midnight. I was writing investment committee memos. And that was back when you wrote a financing memorandum to go get debt. You put together a 100-page memo that you'd print and then FedEx to 20 different banks.
Right. I remember that. And your credenza in back of you was stacked with stuff.
Yeah. So I think, and again, not that I, haven't picked it up obviously along the way here, but I think if earlier on I would have figured out how to maybe spend a little bit of time stepping out of the daily and nightly minutia of the analyst and associate level stuff, and just at least started to think about and tried to learn some of that director and above stuff.
little more of the meta related stuff.
Yeah, exactly.
Very cool. Well, Scott, this has been great. I want you to give my best to Phil and Brian, two fabulous guys who I really, really do like. They're just good, solid people. And you too belong in that category. But this has been great. So if people want to know more about HealthEdge, how do they find out? There's what's your website?
Yep, HealthEdgePartners.com. We upgraded the site, I guess, about a year or so ago. So we've actually got video production on there now, and it's
nice.
a little more interactive than the 1998 kind of level website we had before. So that, and then contacting any of us at the firm is always welcome. We love talking.
Sure, HealthEdgePartners.com. All righty, man. Listen, this has been great. I appreciate it. Good talking with you. And until we talk again.
Yes, sir.
Thank you for listening. Please visit us online at touchstonegroupllc.com.